For this podcast, we're proud to partner with Zurich Life and Investments. As one of the last true independent life insurers, Zurich has always believed in the value of advice and the professionals who provide it. They continue to invest in programs such as this one that are designed to strengthen the health and reputation of the advice profession. They're excited about the chance to partner with us, XY Advisor, to help shape the future direction of advice and help make it more accessible to more Australians. To find out more or to check out some of the latest advisor support tools, visit the website or ask your Zurich BDM.
We all know education is one of the biggest things in the industry at the moment. It's why we've created the XY Advisor platform. It allows advisors to do short 4-week courses. And what we're really keen to do is to get as many awesome content providers in there. So if you're an advisor or a service provider who have put together an awesome solution which can affect change in the way an advisor does their job on a Monday morning, please do put together an application for us at www.xyadvisor.com.
G'day. How's it going? What do you know? Strike a light. Michael Houlihan, thank you for joining us on the XY podcast.
Pleasure to be here.
Yeah, mate. So you're a VFL, AFL enthusiast.
Yes. Tragic.
And you were telling me earlier today that you played twice. Was it last weekend? The over 45s and the over 50s.
Correct. Yeah.
Now, if I have a picnic in the sun with my fiance and I'm 35, I get covered in bruises. How do you manage to do something like that?
My wife calls it stupidity. I call it a passion for the game. I'm an AFL tragic. I've played since I was 9 years old. Went through amateur football till I was about 26.
Yeah.
Then had a 23-year break.
Yeah, how come?
Marriage, kids.
Yeah, okay.
And in that 23s, it was interesting that two lovely girls, one 22 who's propping up the European economy right now on my money.
Doing a part.
Yeah. Doing a part. They're very good parts. And an 11-year-old girl. So when they were growing up, it was all ballet. So I spent 15 years at ballet class and
how is your pirouette, mate?
Pirouette's really good. And then after a period of time, I joined the board of my daughter's school, and one of the guys there was playing footy. What we call veterans football or super rules in Melbourne. So he said, why don't you come down, have a bit of a run? And I was miles overweight back then, about 30 kilos overweight.
No way.
Yeah. And went down for a run, fell in love with the game again, lost about 10 kilos in the first, 2 or 3 months. Had the first game and back in love with it. So, and 6 years later, still playing.
Wow.
And so when did they install the winery at the school? Was that before or after the football?
Actually, the winery, that was well before. That's
where the 30 Ks. Exactly.
And they're quite often where the pre-season training occurs as well. So.
Oh, very nice. And so you live northeastern Melbourne,
yep,
right on the edge of suburbia, I think you mentioned, on this lovely wine area. And when you're not sort of enjoying, the views from your back porch, which I'm sure are fantastic, you're a part of a financial planning firm.
Yes.
And a superannuation administration company.
Yes.
You're on the board of your daughter's school.
Yep.
And you're playing football. Mate, what else don't you do?
And I'm treasurer of the club too, by the way.
Yeah, of course you are. Of course you are.
And director of a research firm as well. But anyway, I just love being involved. I've always been, I go back to when I was at school, which was an all-boys school back in Melbourne, and I was always involved in something there, whether it was coordinating dinner dances or things like that, always involved. So as I've gone through life, I've just always been involved.
You're showing your age there, mate, with those dinner dances.
Yeah,
Jeez,
I know.
Come on. I'm surprised you've got time to be sitting here with us today with the spotlight on Super, the Royal Commission.
Yeah, well, that's been interesting. I think, we've got both the Royal Commission going on, but there's also the Productivity Commission report that's come up recently as well. So I think if you go out 5 years, the whole landscape of super is going to be vastly different to what we see today. Vastly different. Where Productivity Commission is looking at having 10 best of breed funds, which have become the default funds for everyone. I'm not quite convinced that will actually go through, but it'll be something similar to that. So you link that in with the Royal Commission, and obviously the Royal Commission is looking at misconduct, dishonesty in the superannuation system, and I just think you'll see a dramatic change to the system over the next 5 to 10 years.
I heard them say the other day that they suspect that possibly, maybe, perhaps the superannuation funds may not have their members' best interests at heart. What are your thoughts on that?
Interesting. Well, if you look at the market segments, so there's 3 market segments. There's industry funds, there's retail funds, and self-managed super funds. All have their place. All do a very good job. Industry funds, what's called profit for members or not-for-profit. And interesting, the Royal Commission, they're probably going to come through that pretty clean. And it sort of makes a bit of sense. They're well regulated. They are not-for-profit. Sure, there might be some related party issues in some funds, but they'll sort of skate through the way it is. Retail super is linked to, obviously, the banking environment. So if you look at the Royal Commission, everything that's coming out last week is all linked still to the banking misconduct, things that are going on, advisory groups being paid incorrectly, being paid for people that have passed away years ago, things like that. Then there's a self-managed super fund segment, which I think is a real important segment of the market because the one that is so closely linked to financial advisors. And if you look at outcomes, member outcomes, things like that, I think the advice part of super is the bit that's missing from the industry super fund segment. The self-managed super funds do really well.
Yeah. Well, we're seeing more of the industry funds that are. I think they've recognised that as well. You see, Australian Super, Sun Super, where they're partnering with advisors and making it really easy for those guys to do that advice element. But I think, with the retail funds, there's advice there, but I don't know. What I see is it seems to me that the legacy products they've not caught up with the times.
Yeah.
Like it's a very commercial marketplace these days for advisors if they're helping people choose these retail funds. So the costs are more competitive, the products are better, but then there's all this legacy stuff which is significantly more expensive when you compare it to what's available today. But there's no, I suppose, directive or motivation for those companies to move anybody.
No.
And then that's I suppose, a less positive outcome for the consumer.
And that's what's coming out of the Royal Commission. So if you look at the MLC in particular, it's majority of their legacy products where you had an embedded cost for advice where members really had to opt out as opposed to opt in. And that's where you've got the big conflict of interest, and you've got
You're talking about trailing commission.
Yeah, or there's advice fees that are sometimes embedded in products as well.
Yeah, okay.
And that's where the issues come out, particularly with MLC, is that there was these things being charged, which was a great revenue earner for MLC and looked great on paper, but they weren't getting anything, the member wasn't getting anything for it. So it's the whole fee for no service argument that's going on. And unfortunately, that sort of tarnished the whole retail industry. But if you look at, and I think you're right, I think you look at the legacy products are where the issues are. The newer type products is where you do have advisors involved because they are the ones that are connecting with the member and with the product for the advice section of it.
But there seems that there's so much sort of this inertia and apathy out there from people that they just don't look like they're, people are, I would say, more than less are dissatisfied with their super, but they just feel like that there's nothing that they can do or don't understand it well enough to make any changes. So I think that's why the legacy things are sticking around for so long, is for not much of a reason, in my opinion, other than people just don't know what to do to change it.
That's a huge part of it. I think the lack of engagement in super is a big issue. Now, again, self-managed super fund segment, that is an engagement bit because you've got the advisor involved, that's already engaged. But if you look at the rest of super, it is really low engagement. And every industry super fund is doing their best. They've got expert people and panels on member engagement, employer engagement. It's very hard. When you've got a compulsory system where you join an employer and automatically you're thrown into a super fund, it's hard to engage that person. They don't need to be engaged. So the engagement normally comes on trigger events. So some change in their personal life, whether it be marriage, kids, divorce, buying a home, whatever else, that triggers the engagement process.
Yeah.
A lot of industry funds are trying to link into that, and they do a very good job, but it's still very hard. It's such a big pool of people. you think, like I'm a CEO of an industry super fund, you think you can engage everyone. Well, you just can't. It doesn't work that way.
Yeah, with the open banking that's coming around, I think that's going to play a very interesting part. So in the UK, as long as the client gives another company permission, a third party, they can dive into any bank accounts. And I think one thing that's probably coming for the industry super funds and whatnot is this access to people's bank accounts. So if that's what the industry super funds are trying to do, which is target people on these key events, and you've got this banking where there's nappies, right, they've got a kid, right, so we can trigger the life stage engagement piece, which. Yeah, look, I think this open banking is going to give a lot of companies a lot of insights on their members. Yeah. It's going to be quite interesting.
Yeah, look, I think the whole industry super fund sector has been quite slow to move in this area in particular because, again, it comes back to the compulsory nature. So if you're an Australian super, you know there's going to be X billions of dollars coming in per month in compulsory contributions. So for a long time, funds just sat on their hands and, well, we don't need to do anything. It's really, we talk about disruptors in the industry, and it's hard to disrupt a superannuation industry that's very highly regulated and governed, but you can disrupt the way you communicate and engage with members, and that's what's happening in the market now. So people are coming into the market, they're engaging well, they've got better technology, better processes. Industry funds now are catching up to what's going on there, which is a good thing. I mean, you're learning from your mistakes and you're learning from the expertise that are out there.
There's so much money in superannuation. The only people that can win is everyone, the Australians. Yep. The competition is brilliant. The end result, the end winner will definitely be Australians, which is great. Yep. And because there's so much money, it's not like any super fund even needs to, maritime. For example, maritime super. So they don't need to roll up or roll away just simply because there are other options out there. I'm sure that the wharfies and those blokes love their maritime super. They don't want to go anywhere. Yeah. So yeah.
Yeah, well, you got to consider where super started in that area was the name industry. So it was an industry that you joined. Australian super sort of changed that because it's so big, and that's not a problem. But yeah, there's connections to the education sector. There's maritime. There's Host Plus for hospitality. There's Hester for health and community. And I think they've got a place. And I think their engagement with that particular cohort is actually very good.
Yeah, well, they're definitely not going anywhere, I wouldn't suspect.
No.
Yeah.
No. Massive.
So you talk about like the changes that are happening in the industry and things that will look very different in the future. What do you think? What do you think are the main things that you imagine will change over the next 5 years or so?
I think that there'll be depending upon how far the Productivity Commission report goes and their recommendations, I think you'll see an acceleration of the merger activity in that part of the market. I mean, there's not that many funds left now, but if you follow the logic of what the Productivity Commission are doing, so best in breed, again, I don't think it'll be exactly that, but it'll be something similar, you'll need to be a very large fund to compete with that. So the idea of the Commission and best in breed is not just based upon performance. There's all sorts of other attributes that go into it, and there's an independent panel that selects those funds. But I think you need to be probably, I'm guessing in, say, 5 years' time, you'd need to be 25 billion up to be able to compete in those sorts of markets for the default market. So again, remember, this is the default market.
I see.
I've had lots of discussions the last few months about this, and if you put your retrospective hat on, which is very easy to do, when my super came in a few years ago, what they should have done, which is controversial, what they should have done was set up one default fund.
Ooh!
One default fund. Because
you communist.
I am. In a way. So the logic behind that is that the whole idea with my super concept was for people that are defaulted into the system that have actually got no choice at all, they're defaulted in through EBAs or union arrangements. They're defaulted in an arrangement that is lower fee arrangement, et cetera, et cetera. Why have competition in that space?
Oh, geez, that's a philosophical question.
It is.
Mate, we could spend all the money on our infrastructure and give everyone a deemed 7% interest rate.
We could do that as well. But I just think it is, as a retrospective hat on, then the arrangement is, okay, if someone opts out of that system, then you opt into an environment is where you've got competition. Because that's where you're trying to attract people with certain cohorts or attributes.
I do like the concept of it. It's the lazy money stays in the safest possible environment, and then if someone is engaged in any manner, then they can opt into another option. Yep. I think you're making way too much sense here, mate.
Sorry.
This is the superannuation industry. Jesus Christ. We have to
But where's the profit margin? And who gets it?
It's interesting. I'm looking at some of the findings that are coming out of the latest round of the RC, and interestingly, this really blew me away. It's always interesting to see what these QCs and people that are looking at the superannuation industry and the financial advice industry from a third party point of view, outwards looking in. And a big trend in financial advice and in products these days, and I think, Ben, you're a pretty big fan of this, is moving to that passive investment. Yeah, it's quite big.
Yep.
In fact, I believe when you look at net inflows and outflows, that 100%, I believe I heard this a couple of times, of new money has gone into passive since the GFC. That after you take in consideration the outflows and the inflows with the active stuff, it's basically all the new flows have gone into passive. That's how popular it is. However, these QCs have turned around and said, well, you're doing nothing for your money then, the advisor. And literally it then went on to say, look, if you'd chosen Ben along, or if you'd chosen, if you'd chosen these active managers, then okay, you're allowed to charge a fee, but not if you're just giving the index. And I was like, wow, that is like the complete opposite of where. Because even the advice to go into passive is certainly worth something. Absolutely.
Yeah, but I think if you're charging a percentage fee on a passive investment strategy, I don't think that's sustainable. Because why?
But don't forget
because you've given
money.
Yeah, but the investment piece of advice is only a very small piece.
Agreed.
Yes.
Very small piece.
Yeah.
As we all know.
I'm very close to 100% passive. With the only deviation of that is pretty much ethical. Most of the time.
And spread
but
out.
I don't.
What?
Maybe employer super offer, financial wellness. What? But yeah, I transition all my clients away from. I was charging a fund fee up until, I suppose it was July or so last year. And it just didn't make sense. For me, I looked at it and I went into all of what we do for an investment management. And, my business is different in that I do high touch coaching and all personal strategy. So I'm spending a lot of time with my clients all the time anyway. But I felt that it wasn't, for someone with 50,000 or 100,000, there wasn't $500 worth of extra time that went in from my part, or not even, 300 and a profit margin.
What about the risk argument? You're taking on more risk.
Yeah. I think that is an argument. I was actually just considering that. I'm talking to a client at the moment, and he's got a couple of mil, which is thank you Atlassian, way more than what I would normally deal with for individuals. Definitely in recent years, but I don't know. I suppose there is probably a little bit more reporting, a little bit more hand-holding there, so probably a higher fee. Definitely there's an argument 50 million to 50,000. You have to charge more, but I don't know. I still haven't really figured out where is the line. What's the work? If I've got 2 million in a Vanguard fund, he's probably going to ask me a few more questions, but is it thousands and thousands of dollars of extra work? Probably not.
No,
Right.
It's not.
Yeah.
But the passive argument's very interesting. You look at, and I will disclaim here, I did work for Vanguard for a number of years. So, but you look at Vanguard's inflow and their FUM now, which is worldwide, which is twice the size of the Australian superannuation industry. So we're $2.6 trillion super. They're double that and probably a bit more. And
in their FUM or their
their FUM,
yeah,
worldwide.
Yeah,
and that's big numbers. You look BlackRock's even bigger than that. They're not just passive, but you look at the Vanguard in Australia, for example. I'm not quite sure what percentage. I'm guessing 90-something% would be all superannuation money in Australia. And in fact, what triggered a lot of the inflows lately has been the introduction of ETFs, obviously, because from an advisory point of view, I'll put my advisor hat on. I'd much rather deal on a direct basis than through a managed fund basis.
Yes.
It's just so much easier to do. So I think accessibility has worked very well for companies like Vanguard. But I think also that again, I go back to the advisory hat on, we've employed a core satellite approach to investing for years. So the core is the index because you know what you're going to get, and then you add spice to that with the satellite investments around that. And that concept to us has worked exceptionally well.
Now, I won't ask for a product recommendation, but what are some themes, some thematic suggestions for your satellites?
Well, the advantage of the satellites is time dependent. So
okay, so you're quite active.
Yep.
Yeah. Okay. Cool.
Yeah. So it might be not quite now, but a few years ago was, healthcare sector, for example, and you can buy ETFs in that area, Australia wide and around the world. Technology, things like that. So it's just a matter of knowing the market, getting the right research and advice. The core doesn't change because the core is the main part of the portfolio. It's the satellites that change. So being a smaller part of the portfolio, you're not adding a lot of risk or cost by changing the satellites.
Sure. And how did you approach doing you said research around the funds? What was the process for choosing what you would use as your satellite?
Well, we have our own investment committee. we filter in research from all over the place. We spend a lot of time talking to investment managers, research houses, whatever else. Form an opinion. We have another independent body person on our investment committee, form an opinion, and then implement that through our portfolios.
So how do you find out about the next Netflix or Afterpay?
Well, we're not trying to find the individual.
Okay.
It's themes.
Ben actually jumped onto Afterpay at what price, mate?
$1.42.
What's it now?
$14.50 or something today.
Wow.
10x. I'm in trouble for my super fund because I'm not supposed to have any individual holding above 25% of my fund, and let me tell you, I'm way above that. They keep saying to me, "Let us sell. You need to sell. You need to sell."
And you're like, I don't want to sell.
Nah. If I would have sold when they told me to sell the first time, I'd be $80,000 worse off.
Oh, yeah.
Yeah.
They've done a remarkable job because they launched in the US, didn't they? And then a competitor in the US almost beat them to it, but then they've established themselves or something to that extent.
They launched in the US and they did the growth in 1 month that they did in 18 months in Australia. It took them 18 months to get to a certain turnover size.
Yes.
Went to the US and did it in a month.
Now, wow. I can't figure it out why people use it. So
I don't know. My wife uses it. I've got a mate that's a broker, and I needed a broker to run that part of my fund, and his wife uses it, and he's loaded, and he's like, I don't know why she's using it. I say the same thing to Yang, and like, just pay for it with the money. Like, the money is there, but I don't know. It's like this weird psychology thing.
I just don't get it how it's different to a credit card. I really, really don't. It's credit, but it's not on a card. But you
can link it to a debit card, which is weird. I don't understand it, but I'll take my 10x. I don't need to
absolutely. No, they've done a remarkably good job, whatever they're doing. Tapped into something I have nothing.
Absolutely.
So do you think that consolidation of funds, do you see that as being the major change coming out of the inquiries that they're making at the moment?
I think that's the major change out of the Productivity Commission report. Interesting that the Royal Commission, and if you look forward a few years anyway on the advisory side, and what's happening there is that we've got the new education standards coming in. They're still being debated, but I think they're reasonably well set with FASEA and what they're going to do. So if you think about what's going to happen there is that you've got a lot of advisors that have been in the industry for a lot of years that don't meet those educational requirements or don't want to go through the new requirements will drop out of the system. So that they're suggesting anywhere between 15 to 25% of advisors will drop out of the system over the next 5 years. Now, there's good and bad with that. The good bit is you're probably getting rid of the ones you want to get rid of. The bad side is there's some really good advisors out there that don't meet the education standards that you're going to lose out of the system. And I think that's a real pity with that.
Yeah. So, I think if Peter Johnson from the AOAP gets his way, they'll all be fine. It's just if you've got an X amount of experience, you should just let him through, apparently. I think he's lobbying for that.
Yeah, he's lobbying for that, yeah. Don't totally agree with that, but anyway, that's...
I'm not sure that he'll get it over the line. I saw that the AFA put out something recently about the FASIA, and they've been talking to Kelly O'Dwyer about trying to get an extension for this exam, which is supposed to be, it was like next year, early next year.
2019,
or something, which they haven't put out the guidelines for. 65% pass rate or something. No one knows what the curriculum is.
Yeah, and it's a closed book exam. But I mean, what that's doing is setting a benchmark. That's the whole idea of that exam.
Yeah.
So the benchmark's the whole industry, and then after that, you've got your educational requirements. So,
yeah.
I agree with what they're doing. I don't think the implementation's right.
Well, I think that sort of timeline, though, is a bit rough. You look at people, and people have got families and businesses, and, everyone's busy these days. It's like, if you want us to study, like, give us some time to study. I don't know.
Yeah, XY, we're trying our best to get involved in this in a way that it makes it easy for advisors, but we don't want to be the ones that come up with the content. So we've been slowly shaping our website to be the holder of educational content. And I will wonder, who do you think will be producing this test? Is it Kaplan, or is it a university, or is it the FPA, or is it the AFA? And who's do we know even to that extent on who's producing this test?
I don't think we know that yet. I know that obviously FASI are dealing with it, but I don't think the concept of who's going to
actually
do it now.
Right, okay.
I think they said it was mainly ethics. That was what I was reading in the AFA. AFA sent a love note around. Predominantly ethics-related questions.
Now, I did the FPA 1 ethics.
Oh man, I did that as well. Whoa.
No, it changed my life. I loved it. I learned so much. Truly. Yeah, because I had no idea that ethics was different for people, right? So in that course, you learn all about utilitarianism and deontology, right? See, the fact that I can just roll those words off my tongue now means I've spoken about it so much, because it throws me so deontology is you do something right because it's the right thing to do, and that is one ethical framework, and a lot of people have that. And then other people have the ethical framework of utilitarianism, which is what's the best outcome for the most amount of people. And depending on what your ethical framework is, the one that you belong in makes sense, and then the other one you're like, oh, well, that's not necessarily bad. But then if you think about it and you go a bit deeper, they do actually clash. Like if you do something because it's the right thing to do, but it might cost damage to the majority of people, then you've got this big clash. And that is one of the things that I learnt from FPA 1.
There we go. Well done.
Thank you.
There's a lot of words, man. 6,000 words or something on ethics. I was just like, oh, man, I'm ethical. All right, come on. Give me a break, guys.
But with which ethical framework were you?
So tell us about the submission process, because you had to put some stuff together for the Royal Commission.
We did too, yes. We were issued with what's called notices to produce.
Sounds scary, man.
It did sound scary at the time. But again, it was this particular Friday, and a lot of the industry super funds, we speak to each other, and we all got issued with these notices on this particular Friday, and relatively short deadline to produce information. So the information they were after, nothing untoward, was all of your board packs, so not the board minutes, but all the supportive stuff for the board meetings. All your committee meetings, went into things like, which sort of made a lot of sense, went into things like directors' remuneration structures, how that worked, related party issues, contracts, remuneration, things like that. So it was a fair chunk of work that came out, and of course the deadlines were pretty short. And it included financial statements as well as that for going back. I think it was about 5 years with it. So it was the interesting process because you get the phone call, you get the email, then you get subpoenaed. Which is an interesting process. Very short timeline, and then you've got to produce. The initial arrangement is to produce hard copies of everything. So you imagine that the fund I'm the CEO of Combined Super, small fund. We probably had, I'm guessing, 60,000 pages.
Wow,
of stuff. We didn't do the hard copy process, and then it's either USB or there's a specific data arrangement that they want. So we issued that. With that, so every
they
fund...
didn't tell you to send it to that old nursing home with all the healthcare records.
No, didn't go there. So it's quite a daunting task. And obviously from that they then ascertained, do they need to dig deeper in certain areas? Now, we didn't get that the next round. Obviously, funds did. And then they're looking, the related party thing was one of the things they're looking at in particular. But obviously, if you look at the MLC arrangement, what's going on there, they've dug very deep and very micro to get to certain issues with that. And I'm guessing when you look at the industry funds that are up against, that are presenting to the Commission, like Australian Super was yesterday. It was a few hours, I believe. Nothing at all came out of that. Off you go sort of thing. And I think you'll find most industry funds will be like that. So the area of the Commission, again, as I said earlier, is looking at linking back through the banking part of it and the same practices occurring in banking that are occurring in superannuation.
And so do you think that the related party thing will cause any issues?
No.
No? Dealt with?
Can we dive into what the related party is? So this is for industry super funds who are basically outsourcing to companies that the board members own, or
things like that, or
the unions,
or the unions own, or the fund itself owns. So
right.
Look at if you go back,
so it's not for profit still. However, they're just all the profits are over there.
Correct. That's right.
And they're really deep diving into this specific topic.
Yep.
It'd be great to find out what goes on there.
Yeah. Well, again, we've got the rest of this week, and I think next week as well with the super parts. I think there'll be more that will come out. But again, if you look at industry or the whole superannuation segment, but industry super funds in particular, with your disclosure requirements, everything is actually disclosed.
Mm. Well, they changed that. They changed it recently, didn't they? Yeah. All of the fees. That was the fee.
Yeah.
Like late.
Well,
that
that was the RG97 fee disclosure. Yeah.
And so is subpoena, does that mean you have to go there? Is that, you'll excuse my ignorance?
No, subpoena is you get issued with a document, which is a court document. So the Royal Commission is a court.
Oh, yeah. So you didn't have to do the ghost?
No.
And subpoena, does that actually, or am I just confusing this with Hollywood, where someone has to hand it to you in person?
Yes.
That's a real thing?
It's a real thing.
Did you try and run away?
No.
You didn't subpoena me. Did they walk up and be like, Michael Houlihan? And you were like, yes, you've been subpoenaed. Is that
actually, what happened was that because they came into the reception of the office.
Yes.
And they said, I'm here to issue a subpoena to Michael Houlihan.
Oh, my God.
And, of course, the staff are gone, okay, what's he done now?
That's terrifying.
Yeah. Do they have to say something? Because it's like in America, they say you've been served or something.
Yeah, so you're being served, and you got to sign something to say you've accepted or received the information.
Was he wearing a wig or something?
No.
Okay.
No.
All right.
No.
Oh, wow.
And so you're running a financial planning business as well?
So a part owner of a financial planning business, yeah.
Right.
Yeah.
And do you any impact from the RC on the business, you see?
Not really. I mean, it's probably more of a. I mean, we like to pride ourselves in our compliance side of the business anyway, but it probably is just a heightened awareness of our disclosure requirements to clients with that. But no, we don't see an impact really.
Anything from clients? You
Nothing at all.
Much conversation?
Nothing at all. No, I think the impact's going to obviously be, the four banks and AMP with that. So in any connection, any branding with those things from an advice point of view, I think is going to cause some issues through clients. But being purely independent, which we are, own licence, we've got no issue at all.
Do you see the future as being less small independent or more small independent licensees?
I actually see more small. Mm-hmm. I think the value of being with someone like AMP, if you look at the bowler arrangements which came out in the Royal Commission as well, so by our last resort, there's an advantage of being with an AMP or a bank if they're going to provide that sort of by our last resort. But if you take that out of the equation, I think there's more value proposition for your clients in being independent than being tied to an organisation. Whether you're utilising the vertically integrated product suite or not, I think post the commission that you're going to be tarnished with that anyway. So I think groups moving more to be independent, I think is a great value proposition.
Do you see, now ducking into that MLC issue for a moment, someone that I know, Paul Mann, actually, we've had him on the podcast a couple of times. He's involved in the Workplace Superannuation Association. He's a part of that board there. So he was saying how the MLC situation they renamed commission to advisor service fee.
Yes.
And then it became a major issue because there was, no service.
Yep.
And they've cut it in the last week or so, right? Or a month. Yep. And that this has cost advisors all over Australia a lot of revenue and sale value. Can this happen? Can the advisors group together and perform a class action against these large financial institutions, even in the event that they are simply doing what the law has issued them to do? Because I've never I don't quite understand where the fault lies. So, for example, with taxi drivers, the fault has lied now with the passengers of Uber and ride-sharing apps. So we pay $1 for every ride that you take in an Uber, and then that goes to a pool of money which is getting paid out to the taxi guys for their license plates because it's cost them so much value. Where is the fault going to? Is it just simply fall at the feet of the advisor?
I think you'll find, going back to the early point, I think there's more the legacy product stuff. So I think you'll find that the commission advisor service, whatever it's called, is not actually going to the advisor. It's going to MLC.
To the company.
And if you look at, I go back years and years in the funds management industry, that was a common thing.
Right.
Was that there'd always be a fee in whatever form charged, and if the advisor was connected, it would go to the advisor. If there's not, it would go to
the company that hold it. Right.
Yeah.
I helped my uncle with his super, and he had an old MLC fund that it must have been set up like maybe 1990 or something. So it was like one of the really early funds before you actually needed to have
the voluntary
a super fund. Started doing the information collection piece. The total fees on his fund were over 6%.
Cool.
Yeah, right.
6%. And he goes, I don't know. He goes, my fund's been at $200,000 for years. I don't know why it's not going up. I know why.
Yeah.
It's crazy, those really early products. Yeah.
That's
I'm sure if you go back far enough, the industry funds were probably similar. I would imagine if you go back to the late 80s and early 90s.
The only thing I could think was that inflation was so high then that they thought that maybe that was reasonable to charge as a fee because the returns.
Yeah, the interest rate at that point would have been 18% in 1990. Right.
And then he just never changed it. This is the inertia that we were talking about.
Oh, absolutely. Yeah. That would have been the case. Yeah, I'm not convinced industry funds would have been caught up in that because it was never the structural arrangement.
Right.
Because again, you go back to these legacy products and things like that. They're owned by an institution.
Yes.
Whereas no one actually owns an industry super fund. So it's not there to make profit. So I would doubt that would have been the case.
And plus the industry funds, I'm just trying to think of an exception to that, but they all just have one line, like one product, right? It's like if the product improves, everyone gets the improvement. It's not like there's this stream and that stream and this legacy and
really.
Legacy. Well, I don't know how many classes of Australian super are there.
I don't know how many products there are.
Like first state super.
How many different products does your industry super fund?
I think product's a dangerous term in this because it's a superannuation fund with investment options. So collectively, that's the product, if you want to call it that way.
Sure.
So that's it. I think was it Host Plus or one of the industry funds had set up managed investment schemes based upon their investment options.
Yes.
So that other super funds could use.
Right.
But there's no Host Plus Pinnacle fund, which is offered from a certain date range, and then they replace it with another thing. It's not like that. I think that's the big difference between the industry guys and the retail, because they just go, this is a product, and then they go, okay, we got a new product which is more competitive. But then everybody there,
so an industry super fund would just have one SPIN or USI number, whereas a retail can have like 100.
It'd be still the one USI. So the USI is just an identifier.
Yes.
So
come on, Clayton, don't you run a super fund or something, mate?
But what industry funds have is investment options.
Yes.
So you join and you join the conservative option. What happens underneath that is subject to the trustees changing the investment structure if they want to change it. with that. But the investment option doesn't change.
The trustees have been getting hammered in the RC.
Yes.
The trustees.
The trustees of retail funds, yes.
Yeah.
That was where they were talking about that sneaking suspicion that perhaps maybe potentially they might not have been acting in the ultimately the best interests of the members.
Yeah, it's a big claim to come out and say that.
But it's hard for a business. Like the retail funds are for-profit enterprises, right? Like clearly the very best thing for the members is to charge them cost, and then the members are the best off. Right?
Yeah, sure. Yes.
But then it's like that's not good for the person providing the fund.
Yeah, of course not.
Well, and then they're paying the
it's
trustee.
It's almost like
this weird thing.
Yeah, it is weird. I mean, everyone likes to bash the banks. It's a bloody Australian pastime, right? But at the same time, you can't demonize these entities for pulling a profit.
Money.
Yeah.
I like to make money.
I mean, it's kind of. I'm reading a lot of this stuff, and it's shock horror. The trustees were actually trying to make money. I'm like, come on.
Yeah.
I mean, how far is the discrepancy between one of these underperforming retail funds and the highest performing industry funds? Like, what is that basis points difference? 50?
Again, it's hard to compare.
You can't compare on performance.
But you can compare the pair.
But even if you try to, what part of the fund are you comparing? Because retail funds have 300 different investment options in there. Which one are you going to compare?
That's why I don't understand.
Very
you
good
get clients that look on these comparison sites on the internet, and they say, and I looked at it because a client sent me something about. It might have been one of the funds that we were using with clients, and they're like, this compares poorly. And I'm like, well,
what are you comparing?
What are you looking at? Are you looking at
your IOOF compares poorly against my Host Plus? It's like, wait a second.
The IOOF super fund?
Was the IOOF super fund cash option?
Yeah.
What is it?
Yeah.
Interesting. When you look at industry funds, so you look at research houses like Super Ratings or Champ West, who put out performance tables monthly. If you look, and obviously in the industry super fund sector, the number of funds has shrunk over the last years significantly. So I can't think what number you're down to now, but you look at the normal distribution of returns. If you go out, say, 5 years, 7 years, 10 years, it's a real narrow normal distribution, which sort of makes sense because you're getting very large funds consolidating. You're investing in relatively the same assets and the same asset allocation relatively. So the differential is very small.
Do you know the guys from Super Ratings?
Yep.
Do you take them out to the vineyard? The vineyards?
No.
Oh, look at this lovely 20-year-old. My goodness, only for the most important people. Mate, you have to send me their email later.
Do you think, though, that that's a problem? Like we were talking before about consumers and the inertia and not knowing what to do and the confusion around that. And you've got these companies, these rating houses, and then they're, a big chunk of their business model is advertising and web traffic, and they're pumping it to consumers to say, come onto this site and check out these funds, and then they're making these comparisons that don't make sense, in particular for the comparisons with the retail funds where it's like, what are the 300 options are you looking at? What's the fee structure? What's the product structure?
Yeah.
Like, surely that's probably confusing people more rather than giving them the information that they're sort of purporting to put out there, right?
Yes and no. I think if you look at the industry segment, so which is the highest level of default people going in, I've never come across a member of a super fund that's gone on to Super Ratings or whatever else to compare super funds because they're defaulted in.
Yeah.
But
they do. But when they decide that they want to make a choice, then that's when they compare.
Yeah, but the comparison is normally the water cooler chat about my performance is better than yours. Yes. It really is. That's how that occurs. And it's rare that they would go to any. This is people not seeking advice, obviously, but it's rare they would actually go and seek anything further than that to say Michael's returns better than Clayton's, so I'm the better one. And that's exactly what happens. It's as simple as that.
Yeah. But it's I don't know. I think it's a major problem with finances generally, but with these products and in particular superannuation, which is such a huge thing for so many people that they're making decisions based on these sorts of things, which is clearly not the best way to do that. Like I don't know. I think the ASIC and Money Smart, that website, fantastic. Could be better, could be more, but I don't know the way to educate people. But I think if people were more educated, they'd make better decisions. It's a shame that there's no resource out there that provides that.
Correct. I think that there's if you look at the way the industry's moved in switching super funds, it's really easy to do now. You do it through SuperStream technology. The requirement from either super fund is a 3-day turnaround. Problem with it, I see, and we are seeing it come out to play, is that if I'm making my decision based on performance, I haven't thought about what insurance options I've got in my fund, what I've got where I'm going to.
Absolutely.
And if I switch, I'm cancelling what I've got now. Am I going to get it automatically when I go?
Yeah.
And that's really
That's
dangerous
another thing
area.
that's come up in the RC is they're butchering super funds for having default insurance. I'm going, oh, come on,
Which is odd, because bear in mind that was brought in with My Super.
Yeah.
So it's a regulatory change that was brought in by the government where insurance for every age group was an opt-out.
Yeah, I mean, for good reason. No, insurance is the one thing you just hope you buy and never claim. There's no point saying, oh, if you never had insurance, you would have saved $20,000 or $30,000 for your life. Okay, but imagine if something gone wrong.
But what will happen if it goes through in the fashion it's put forward now is that insurance premiums for everyone else is going to go up 20% because the group under 25 subsidise through the premiums older age groups.
So surely that's not right, though.
No, that's
like
not.
You should just charge less for those people. If you can't have one group propping up another group.
But it's the pooling arrangement of insurance.
That's how insurance works.
Yeah, but it should be cheaper. To the point that it should be balanced, right? Surely.
Yeah,
because otherwise it's not fair. If you're going, well,
I know this might freak you out, but younger people are generally healthier.
Yeah, but they should be charged less. You can't say
they are.
They are.
Yeah, but then how are they propping it up? Because if you're saying
because there's such a small chance of okay. So what you're saying is, I get the point. You're going into financial planner mode. Basically, you're saying don't get insurance now if you're under 25 because you're getting ripped.
No. I'm not saying that. No. I wasn't aware that that's the case. But I feel like if that is a problem, then it means that the young people are getting ripped off because it should be that you're paying out X dollars, X percent per dollar of premiums claimed. I think that's how. Well, I thought that's how insurance works, right? They figure out how likely are you to claim. We need to charge this. This is our margin. So therefore, that's the cost of the cover.
I think people over sort of 40 would end up just getting charged so much it would become unreasonable. And the charge.
If they got level premiums from Private Wealth when they were 32, Clayton.
Oh, please.
That's what I mean. People need to be educated, think about this stuff now so that they can set themselves up in the right way. But it's,
level premiums. They need to stick that in front of a Royal Commission.
You're talking about like group insurance arrangements, but we've already got non-group insurance arrangements. So, premiums, I think, especially with the massive hikes in the industry funds, they're becoming very comparable. In some cases, like I would say almost cheaper with some of the guys that I look at, really good retail contracts in comparison to some of the more expensive industry funds for those ones. They're very comparable. But so you can't say that old people are going to get charged heaps more if retail insurers are already offering individual contracts at competitive rates. Do you know what I mean?
Correct, but within the insurance company, they're still pooling the risk.
Yeah.
So the logic is that the premium for a 25-year-old is obviously much less than a 55-year-old, but the likelihood of a claim of a 55-year-old is much, much greater.
Yeah.
So that's the logic. So your premium might be higher, but your payout's a lot higher.
So level premiums all the way is what you're saying. Good, I'm on the right track then.
Yeah, it's turned into a contentious issue. Level premiums.
Yeah.
Yeah, well, just because across the industry, let's face it, it's mental illness. It's the mental stress, right? That people are claiming for everything, my job stresses me out, therefore I can never work again and I'm getting all this money. And then everyone else's premiums, even on level, have gone up 10, 15% in a year kind of thing.
Yeah, but 10 or 15% is not 100%. This is what I tell my client. I had a guy, I
Good
did an
point.
SOA
Good
meeting
point.
this morning,
Good
and I
point.
said, look, in the next 3 years, the insurance company, they did all level premiums. I said, the insurance company are going to put your premiums up. I said, they did it a little while back. It was 5% for lump sum. It was 10% for income replacement. Expect that will happen, but it's never going to go from, they were paying, $60 a month for a $200,000 life and trauma contract. That would have been $40 if they got on a step premium, maybe 30-ish. But then, 5 years from now, that's $100. 5 years after that, it's $200. Like,
sure.
They're still going to be way, way, way better off. So, yeah, like the insurance companies, one, they're losing money from a lot of these mental health claims, but two, they're insurance companies. So, like,
I'd like to see a limit on mental health claims. I'd like to see 5 years or something. Like, how long can you be stressed for?
I don't know. I'm helping someone with the TPD. Actually, just got paid a TPD claim at the moment, $750,000
For a stress,
mental breakdown.
Wow.
Yeah, but he's actually. It's weird because he got the claim and he. I didn't actually know that he was going through the process. He's a family friend, and he got a mate had something with Slater and Gordon and got them involved, and clearly they did a good job, and they got the claim up for him. Charge a pretty penny for their services, but he was quite happy because it was money that he probably wouldn't have got or done all the things himself because he was very stressed out of it at the time. But now he's got the money and he's
not so stressed anymore, is he? Probably go back to work next week.
Well, he can go back to work. That's the thing, because can go back to. Can they said that you can have the money, you can retrain yourself to go and do a different job. So yeah, it's an interesting.
It's very interesting.
Just aside from that, there's some insurers are looking at that at the moment and saying, well, rather than paying out a lump sum TPD, they'll pay it out over, say, a 5-year period, but based upon qualifications.
Yeah,
sort of thing.
So I was a bit confused about that though, because it was.
Then you get people walking around with the equivalent of that, the sponge around the neck. They'll walk around with like a propeller hat or something. Like, oh, I'm deep stressed.
Still stressed. It's I thought it was a funny one because the claim was it was a group contract in a super. It was with AMP, and I thought that was all any occupation, but they were basically saying you could take the money, retrain yourself, and do another occupation. Maybe they didn't have that clause, or any occupation that you could reasonably be expected
absolutely.
to retrain.
Look, as soon as you receive insurance, they can't stop you from living your life again. Yeah.
Yeah.
But, mate, I believe you've got a flight to catch.
I do.
So thank you
Melbourne.
very much for coming in and sharing your words of wisdom, mate. You've got a really cool insight. If anyone wanted to reach out to you, are you on LinkedIn or Twitter? Are you
on LinkedIn,
those?
yes.
Yep.
Yes.
Very cool. In amongst one of the plethora of your companies, I'm sure they can track you down.
Yeah.
But I really appreciate your time here, mate.
No
Thank
worries.
you very much.
Absolute pleasure. Thanks, guys.
Cheers. Bye.
Thank you.